Yeah, it's a great question. I think the key question any investor has right now. With low interest rates, the hurdle rates for returns have gone down, and I think the opportunity or the desire to get higher returns has never been greater, and so the people are taking more and more risk. That's showing up in multiples right now. Certainly the perceived safer businesses trade at multiples we haven't seen in our careers in some cases because, again, they have decent growth dynamics. Everybody perceives them to be of high quality, which they are in some cases. And so risk to us is not is really a permanent loss of capital. And that can come from paying too much for an asset. So we as investors are very multiple sensitive. Again, for us to generate double-digit returns, we have to pay sort of single-digit EBITDA multiples. That's very hard to do in a world where interest rates are zero in a lot of countries. Dividend yields are higher than treasury rates, right? There's negative interest rates in a big part of Europe and Japan right now. And so there's no doubt that people are moving out on the risk curve. We continue to believe that you have to be valuation sensitive, or else you take that argument to the extreme. You pay any price for something that's perceived safe. And living through 07, 08, or the Asian crisis in the mid-90s that won't hold, right? So we continue to construct portfolios on a barbell approach of some of our safest, highest earnings quality businesses and currencies that are the strongest in the world with low leverage ratios. Those are the businesses with the higher weights in our portfolio. Again, they're not the businesses that will necessarily make the most money, okay? But we think that they can keep moving the ball forward from a compounding perspective. And then we supplement that on the other end of the barbell with businesses we think have much higher returns, but are in places like emerging markets or are going through restructurings, where the value is not so potentially obvious today. It's perceived to be riskier today, but we think that we're being paid to take that risk. Yeah, I think for us as quality-based investors, we're all looking for businesses that have high returns on invested capital, net cash. They have brands, they have franchises, they dominate a geographic or a product niche. These are businesses that generate real cash flow and can grow that cash flow over time. Now, you don't get a great business, in our view, you don't get a great business like that with an under-levered balance sheet and a great management team for a cheap price unless there's a problem or a dislocation. And so, problems like that can occur through geopolitical challenges. They can come from sector challenges. They can come from an old management that made a bad acquisition, but buried within that is a really strong franchise. So the key to us is finding those good businesses where the value is obviously not priced in, and we're projecting out earnings power that's greater than it is today at some point in the future. I think the stumbling block right now is especially in a place like Australia, which is a reasonably small market from a sector perspective, is you've got a lot of people that have moved out of the commodities, perhaps the banking sector, moving into the perceived higher quality businesses, but you're paying ever higher and higher multiples, right, for that perceived safety. And so any sort of earnings downgrade hits you doubly hard in a situation like that.